It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Getting the right type of life insurance for your unique situation is really dependent upon your financial plan. And for many situations, it is appropriate to use term life insurance, but that doesn't apply to all. We're reviewing times when term life insurance may not be the best option. That and more on this episode of the Wise Money Show.
Talking about comprehensive financial planning, all 6 areas, right? Protection planning. That's where you're going to make some big risk management decisions, but you've got to know how it impacts the rest of your financial life. We're going to help you with that. If you have a question for the program, we'd love to hear from you. You can call or text us 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com is where you can find us. And then all over social media, wherever you're at, we are there as well. Search The Wise Money Show. Big example. This is sort of what was going through my mind. One of our all-star team members, Josh Fritzke, was meeting with one of his roles is to help businesses and employees of businesses sign up for their 401k and get enrolled, have a vision for their financial future that they can create and start saving. And in a recent discussion there with an employee, it was the employee brought up life insurance. And I believe a younger individual, I don't know all the details, but my life insurance this, and it's costing me this much. And Josh had the wherewithal to say, wait a second, it's costing how much? And turns out, when we don't know the future, I'm just going to say, well, the individual appeared to have a temporary life insurance need and did not have temporary insurance coverage, and therefore it was costing a lot. And so instead, I talked to him a little bit about those differences, and then looked at term insurance or a temporary insurance and was able to get a lot more coverage at a lot cheaper price, and it was a huge win. It's fantastic.
Yeah, and well, not only was it expensive, because Josh, his office is right across the hall from mine, and when he came back, he was super pumped for a couple of reasons. But when he came back to the office after meeting with this client and helping them, he was explaining it, and yes, it was expensive, and there was there's $46 of cash value or something like that. So this person had been paying a lot of money, and cash flow wise, it was difficult for him, but he had a low insurance amount and no cash value to show for it. So it was the trifecta of horribleness. And the amazing thing is, Josh, in that appointment, helped the guy and left with the guy having the insurance in place, which still is not really fathomable to me, because I started my career in 1994, and this is where you used primarily cash value life insurance, term insurance. The term insurance that's available today, it wasn't available, and it was still fairly expensive, and you had cash value life insurance, which in essence, I would call it the forerunner of the Roth IRA.
Yeah. And now term insurance, very efficient. There's a large market, right? So it makes the insurance very efficient. And yeah, go ahead, Josh. I was cut you off.
Well, no, I was just going to point out that it's not that maybe this individual that Josh was meeting with had a bad plan in place, but even if we called it good, let's be generous, it wasn't great.
Right.
And part of that was just simply they had a certain objective or a certain job, a certain risk they were trying to manage, and they were just using the wrong tool for it. And there are plenty of tools out there. Just like I can go to the hardware store and I see all kinds of tools, you want the right tool for the job. And that's why you need to have some understanding about the different types of life insurance. This particular person may have been using the wrong one initially and has gotten that corrected. But how do you know? First of all, what are you trying to achieve with life insurance in general? And then how do you use the right type of policy to pull it off?
Let me quickly zoom out before we zoom in. So zooming out, even just this example, person was paying a lot, present financial position. They were getting coverage, but they didn't have a ton of coverage. Protection planning. Okay, it wasn't accumulating cash value. So some of the time, these sorts of life insurance are considered investments as well. So investment planning, not helpful there. And then estate planning. I mean, all of this is there for if he passes away, what's there. And again, it wasn't really checking the box there. So right away, you've got 4 out of the 6 areas of your financial life that need to be considered, which is why Josh can confidently say, even if this was a good thing, it wasn't great, because great would be really ringing the bell in a lot of those areas of your financial life, bringing synergy. So the difference is when you're making a life insurance choice, it's a financial planning decision. How do you manage the risk? What is the risk? And then what are your options? What are those tools? Which ones bring the most benefit to the most areas of your financial life? And that decision, there's a lot of different flavors, a lot of different tools. It's temporary insurance or term versus permanent insurance, which is sort of cash value. Josh, can you help us unpack, explain the difference?
To me, I would zoom out just a little bit more and talk about the philosophy of life insurance. Like, what do you need life insurance to do? If you or your spouse had passed away yesterday, and they're through the tears and everything, all the beginning of Plan B today, what do you need life insurance to accomplish if you were gone? And for most people, it's to replace the income of a breadwinner, for starters. If you were earning a paycheck and that paycheck ended because of a tragedy, then what happens to your family? How do you replace that income for them? Life insurance is one way to do that. Also, if you had been living and lived into your 90s, a long life, you will have achieved certain goals in your life. There are certain milestones that you are going to accomplish, but all of that would have been cut short if you passed away prematurely. Things like paying off your mortgage, saving up for college, eliminating debt, your spouse, the family being able to retire someday. All of those are goals that life insurance can pre-fund for you. And then, of course, there's expenses, final expenses, funerals, that sort of thing when someone passes away. And so people think of life insurance as achieving these things. And if that's true, then I would ask you the question, is it possible that over time the need for life insurance will be declining and eventually going away? And for many people, that big milestone, they've achieved that point of essentially being self-insured or not needing life insurance anymore. Often we think of that as happening when they reach retirement. Mm-hmm. That's when you no longer need to replace an income because you are walking away from a paycheck anyway. Yep. That's when you've probably achieved most of the most important goals for your family, so you don't need to pre-fund those. And so if that's true, if there's coming a day when your life insurance need will shrink down to zero, then buying term insurance or temporary coverage to cover that window of time is for many people appropriate, but not everybody. And that's kind of the point of today's episode, right? What are those times when you actually have a more permanent, longer lasting life insurance need, and how do you get the right tool in that case?
Yeah, because term insurance is going to be the right tool for many situations, but not in all. And so we're not trying to over-exaggerate those exceptions, but we are pointing them out because I do think a lot of times people press the easy button because it's not fun to talk about life insurance, not fun to get it in place. So I'll just get term and I'm fine. And really it's not what you need. So we've got several of them we're going to hit. And one of the first times that term insurance, or first reasons why term insurance maybe isn't best in this instance, is if you have a special needs child.
Yeah, if you have a son or daughter who is dependent upon you today and will still be dependent upon you even in adulthood, maybe it's one of the kids who probably will be living with you or just needing extra care and everything. Life insurance is a way to set aside essentially a pool of resources, usually in a special trust, very intentionally built trust, for their benefit, a pool of resources that can help support them long past your lifetime.
Yeah, and so you're going to want to combine getting the right type of life insurance with the work with an attorney, the legal work to get that special trust set up so that the beneficiary of the life insurance is accurate and everything flows the way it should. Otherwise, if you do it wrong, this blessing could end up being a really painful experience. So, okay, that's just one, and there's a little bit more we'll hit with that. But then what are the other times when term insurance maybe is good, but it's not the best tool? That and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time. Also on podcast at the same time, but also on a couple local radio stations at the same time as well, which is why the content is broken up the way that it is, why it's as long as it is, and so on. And so yeah. But if you're looking for something that's more specific, more direct, something shorter, then we've got that for you too, right here on this channel. Well over 1,000 videos of next wise step videos that take one financial concept from a financial planning perspective and applying it to your financial life, all so that you can take your next wise step in your financial life. So make sure you hit that subscribe button, turn on notifications so you're aware every time we drop new content. If you like the content, like the content. Thank you very much. Okay.
Yeah. Okay. So what are we going to hit this one? Oh, shoot.
Well, we can
Finish
yeah.
special needs.
You stopped at a point where I'm like, I don't know if he has more to say. Or
well, I
not.
didn't feel like we could fully unpack it
Okay.
in that minute. So
Got it. So we'll pick that one back up, and then we'll get into estate liquidity for taxes, and then estate enhancement. So I doubt we'll get into all that in this second segment. But here we go. You may have heard the phrase, buy term and invest the difference. Love that phrase. Love it. I don't have the t-shirt, but big fan of it. However, that really makes a ton of sense unless you don't have a temporary insurance need. In that situation, term and invest the difference might not be the best strategy. We're helping with those exceptions right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KF2 studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com. And then wherever you're at on social media, you can find us there as well. Search the Wise Money Show. So there's most situations, and I don't know, guys, 90%, 95%, I don't know. It's a lot where the life insurance need, the philosophy behind the need is, it's a temporary need. At some point, you're going to be self-insured, so get term insurance. Rent the coverage while you need it. But that's not every situation, which is why the phrase, buy term and invest the difference, can be a little dangerous. It's going to make sense to the masses, but just say that. But if it's misapplied, you got the wrong stuff. And when we're talking about life insurance, hey, the wrong stuff has enormous consequences, real consequences. It's a financial planning decision. Work with your CFP. There are instances where term isn't best. One of them is in a special needs planning situation. Josh, we were talking about the approach with special needs trust and everything. What else needs to be hit there?
well, again, just to reiterate that for most parents, as you're raising your kids, it's with an end in mind. You have a certain goal of helping them reach adulthood, be independent. They hopefully leave your home with a common faith that you've instilled in them, a common worldview, the ability to be productive and to go raise kids of their own, right? But there are times when, because of a disability, it could be a learning disability, it could be a physical disability, you may have a son or a daughter, someone who is going to be dependent upon you longer into adulthood, maybe indefinitely. And if that's the case, then buying insurance for a 20-year period or a 30-year period may not be long enough, because if you passed away even 35 years from now or 40 years from now, there may still be a need to be able to care for this individual who's still part of your household when you pass away. And so there is an entire area of estate planning. It's sort of a subset of specialized financial planning called special needs planning. And there are provisions that you can build into your estate plan to set up trusts that will assign someone to manage assets that you leave behind for the benefit of that son or daughter, someone who can care for this individual and manage the finances long past your lifetime. And it's an important thing to put in place. It's also something that can get messed up really easily. Because if you leave life insurance behind directly to that son or daughter, it might disqualify them for some of the state or social type benefits that are available out there as well. So this is absolutely an area where having a certified financial planner who can guide you through the decision making and the planning, even while your son or daughter may still be in elementary school. You know, you may not know really what their limitations are, what their capabilities will be, any of that. But you can still be planning ahead and having a game plan that's flexible enough to benefit them even after you're gone.
Yeah. Okay, another instance when term insurance probably doesn't get the job done, probably not the right tool for the job, and that is when you need estate liquidity to pay estate taxes. Now, we're at the time we're recording this, it's still unclear exactly what's going to happen with tax laws and whether they're going to sunset. Odds are, or it seems like they will be extended and not sunset. But if they do, there would be a big change to the estate tax exemptions, and even if they're extended, it's possible they get extended through new tax laws that could also change the estate tax. So even if, so there's a lot of uncertainty out there. Work with your CFP, be aware, plan ahead. But let's say even your estate, you own a small business and whatnot that's done really well, and your estate's $25 million. Mm-hmm. And when you pass away, yeah, there's an estate exemption. So a chunk of that will be ignored, but the remaining amount, there will be tax due. And you might say, that's not fair. I know. I'm not gonna argue with you on that one. However, that could cause you to say, well, how do I come up with this cash? Do I need to borrow a bunch of money and pay a lot of interest? Do I need to, would I be forced to sell some of the business? And a way to create liquidity to pay the taxes is to get insurance in place, life insurance.
Right. Federal estate taxes don't apply to everyone. And, some folks have, early in my career, I said, why is there a federal estate tax? You mean I work hard and pay my taxes my whole career and I accumulate above a certain amount, and then when I'm gone, that amount gets taxed as well in the form of federal estate tax? And
at extreme rates too, right? I mean, they could be 40, 50% of an amount above this threshold that goes to Uncle Sam. And yeah, how do you come up with that cash if you're in their sights, if you're the bullseye,
right?
Man, coming up with that kind of cash is tough.
Because it's different if you have cash and you've accumulated cash. So I asked one of the salty old financial planners. His name is Kevin Carmichael. I said, Kevin, why is there this federal estate tax? And he said, because dead people don't vote. Mm-hmm. And I thought about it, and I think, well, I guess that's kind of true. And so the issue is, well, who's impacted by the federal estate tax? Because if all my wealth today, if I have wealth north of $28 million, that is, to oversimplify, anything north of $28 million is going to be taxed at 40%. I like to say 50 to make it simple. Yeah. So anything above 28. So if I've accumulated $38 million, I've got $10 million subject to federal estate tax. That's a $5 million tax bill. That's fine if it's all in cash and securities and other investments like that. It's really tough if it's in the form of farm ground that my family is using to generate income. Yeah. So or if I have a machine shop, mm-hmm. and it's in the form of various tools and machinery. So federal estate tax is something that you want to plan for, because you might say, hey, we don't want to have a liquidity event at this point in time. What can we do? And you can use permanent insurance to create the liquidity, as Mike mentioned. With knowing that you have to do it right, because if you don't do it right, the death benefit would add to your taxable estate for federal estate tax
That could be a
purposes.
circular calculation there.
Oh,
yeah.
brother.
That's right. If you had $5 million of life insurance and now that is being taxed at
As well.
40 or 50%, that adds insult to injury there. But and you might be saying, hey, I don't have an estate that's big enough to be targeted by them in the current laws. But you don't have to go back very far in history to where many more people were subject to estate tax laws. Who knows? How far do you have to go out into the future before now all of a sudden it's popular again to try to really attack some of these larger estates? And so the issue with life insurance is you have to have your game plan in place. You have to have the tool in place while you're still insurable, right? While you're young enough to pay smaller premiums, while your health history is still pristine and you haven't had any kind of diagnoses that make it either too difficult, too expensive, or maybe even impossible to buy life insurance. So life insurance is one of those things that you have to have. You have to be proactive. You have to be thinking ahead. And so it is important to not just look at the laws that are prevailing today, but recognize, well, what might I be subject to out there in the future? Do I need to put the solution in place early?
Yep. It could also be, some estate liquidity. We're talking about for taxes. It could be there's a large asset in the family and you've got 3 kids and one wants it. Well, okay, so how's that one going to buy out the other 2? And if that's you, if you're looking and saying, yeah, there's a property or there's a business or there's whatever, and I want to buy out the siblings and I don't want to create this big financial hardship or this frustration where they're feeling like, oh, I'm trying to buy it for pennies on the dollar simply because it's going to require a lot of cash, then getting life insurance in place can provide that liquidity to help as well. And you just pay the premium on it. Maybe that's what you're doing. So estate liquidity is another reason why term may not be best at certain instances. What other instances? We've got that more coming up on the Wise Money Show with Korhorn Financial Group. Did have I don't read, like, comments can get toxic. That's like just a difficult place. Yeah. However, there was one. I don't even know what video it was, where the person said, it was like, bruh, YouTube's free, right? People watching don't have a lot of money. And I was like, it made me laugh. Because I can't remember, one of the shows is like one of those more advanced, we're talking about, so I can just imagine people here saying, no one listening has 50 million. No, you'd be surprised. You would be surprised. Or you'd be surprised who is saving up aggressively, but mom and dad have a big estate because they've got the farmland or whatever. And so you'd be surprised. But that comment made me laugh.
That is funny, especially that he called you a bra. But so I just wonder, the family business.
Term of endearment these days.
That's right.
Yeah.
Bra?
It makes me go a little crazy when I hear it from my kids, though.
I know.
But I'm not your bro.
Yeah.
Lindsay,
I'm your dad.
Your oldest is.
I'm not a dude.
Your oldest is how old?
5.
And then, like, percentage of time he says mom, mama, or bro. What's the percent? Like, is it majority bro?
Not majority, but he definitely says bruh.
Yeah.
Because he hangs out with high school kids,
he
right?
does, yeah.
He's right there at every basketball practice.
All right.
Okay, so we talked about family business. Do we say second marriage? Is that, because that to me that would be the
Is that the estate enhancement? Like, there's a few different categories there.
That's a planning tool.
I think that's a great segue, as like right in between. So let's hit that first, because it will lead right into, well, you could argue that's estate enhancement, which is the third reason. So let's start there.
I'm not arguing.
I am.
Oh, Jinx.
You owe me a Coke.
1, 2, 3, 4, 5, 6, 7, 8, 9, 10.
All right.
You owe me some diabetes.
Here we go. What are some of the times when term insurance isn't best? It could be good, but it really doesn't. It's not the tool for the job. We're helping with that Right now, this is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen, just search the Wise Money Show. Subscribe to it there and follow us there. And then rate the program there as well. That's helpful feedback for us and also helps others who are looking for content on wise financial principles, helps them find us as well. So we appreciate that. Check out the Wise Money Show on podcast. Talking about the times, rare, yes, but still there are instances, times when term life insurance isn't best. And you might have a need or a situation where getting a different type of insurance is appropriate. One of the ones we were just talking about is when you have a need for estate liquidity. That could be to cover taxes, could be other reasons. Kevin, you brought up one at the break. We got to hit this as well.
Well, the second marriage. So if you're married for 30 years and you accumulate a certain amount of wealth, and then your spouse dies, and you say, okay, and I remember that happened early in my career, and actually I went down the hall and talked to the salty old advisor, Kevin Carmichael, and I said, Kevin, what should I do? They've got this permanent policy that they're paying money for. She died. He's got the permanent policy on him. Let's cancel that and help his budget out. And he said, no, don't do that. And I said, why? And he said, keep that in place. He's going to get remarried. And I said, what do you mean he's going to get remarried? He's like, no, he's going to get remarried. Keep it in place. And Kevin didn't even know the guy. He just knew the profile. And he was absolutely right, because when the situation happens where one of the spouse dies and then there's the next marriage, the question is, and I had this conversation with my dad, and he said, well, what do you think I should do? And I said, well, I don't know, Dad. My feelings might be hurt a little bit if everything that you and Mom worked your whole life for went to your next wife's children, or your next wife's next husband. Or your next wife's next husband's children. I mean, go on. You could be all kinds of crazy with it. So life insurance is a great way to say, hey, look, we've got these assets that we've accumulated, but we also have this tool for leveraging dollars. That's life insurance. So we can make one of the parties a beneficiary of certain assets, and we can make one of the parties beneficiaries of the life insurance policy. So it's a great way if you say, hey, I want to take care of my children, to pull that off. Yeah.
Mm-hmm. I'll throw one more group in there. If you have certain assets that you would really like to have go to a charity, some assets are great to leave to charity. Others would be less efficient. The great assets to leave to a charity are the ones that have a tax bill attached to them.
Yes.
Think about your 401k or your traditional IRA. If a charity receives that and cashes it in, all those income taxes are eliminated because they don't pay taxes. Mm-hmm. But you also just left an asset that maybe your kids or grandkids would have really benefited from. And so life insurance could be a way to free up money to go to the causes that you care about without it coming at the expense of the people you care about. Mm-hmm. So, leave the life insurance to the kids and grandkids because it is tax-free to them, income tax-free, and the charity pays no taxes. So everybody wins except Uncle Sam, which sounds like a party to me.
Yeah. The second reason we're talking about, or the third reason we're talking about, estate liquidity, is very closely related to the next one, which is estate enhancement. You could even argue the planning for the second marriage or planning for charitable giving is a way of estate enhancement. And listen, this isn't going to be on the quiz, so you don't need to perfectly categorize it, but it's just a different mindset shift. Because within estate enhancement, think about this. One of my financial goals is to leave an inheritance to the kids. Mm-hmm. And I'm saying that as an example, but I actually know that is one of mine, and I have no idea. There's hopefully a lot of life left, and we'll see if things change. But if that's something that you have a goal to do, well, how do you ensure that that's done? Well, you can oversave and really save up a lot, but you also don't have control over those future expenses too. So maybe you say, no, I just want to do something to make sure that my estate is enhanced. And there's some inheritance there, some dollars that are created when I pass away. And term life insurance may not do that because it's temporary. Now, the other thing, going back to this assets to leave to charity, at some point, right now that age is 73, in the future it'll be 75, you're going to be forced to start taking money out of those pre-tax retirement accounts. And if that's you and you're envisioning, yep, and someday my kids will inherit that pre-tax retirement account, know that they now have to take all that money out within 10 years. What if that required minimum distribution, that requirement, you got permanent life insurance or cash value life insurance in place for your estate enhancement goal, but instead of leaving that IRA to them as big as you possibly could, you're using your RMD or withdrawals from that IRA to pay a life insurance premium. And if that meant your IRA was a little bit smaller than it otherwise would be at your passing, well, again, what would the kids rather inherit, life insurance or an IRA? Well, the life insurance is going to be tax-free and a lot of flexibility with it. The IRA is going to be taxable and a lot of restrictions as far as when it needs to be pulled out. So again, like if you are not excited by the idea of leaving an inheritance to the kids, fine. And then this estate enhancement reason might not be one that's for you. But for those of you where this is a big deal, what's the strategy?
Yeah, I like, I'm thinking of an example of a client who there has been a lake property in the family for a couple generations. And it's been the gathering place. I mean, so many family traditions, so many memories there. The thought of it leaving the family when they pass away, it's not tolerable. They just can't imagine that happening. And so an example of a use of permanent life insurance may be to essentially endow an asset. I've heard of, spouses in a second marriage situation endowing their own home so that when their second husband or second wife is a survivor, they can stay in the house and know that the upkeep and the care is managed, because that house, when the second to die passes away, it's going to go down to the kids. But what kind of conditions is it going to be in? Has it been maintained well and everything? Well, there's costs to leaving assets behind. There's tax bills and stuff like that. And so life insurance is a way to create cash when a need pops up as well, right? Out of thin air, you can create capital when the risk or the need also is created out of thin air.
All right, let's talk about the next one, and that is also when a need arises. Kevin, when you started your career, long-term care insurance was just getting up and running, like a specific insurance to cover a very specific need. And then Josh and I, as we started our career, at least in Indiana, but even across the country, there was energy around this. And I'm telling you, that energy is zapped. This is the number of people needing assistance in long-term care services has been greatly more than what they expected, and the cost of those services has been way above projections as well. And when you miss it by that much, you don't have an efficient way of transferring risk, and therefore long-term care insurance specifically, to go out and get a new policy today, it's difficult. What if you already have a policy? You are lucky. You are lucky,
and you're paying more.
And you're paying more.
They keep ratcheting up the costs, or they will say, hey, listen, you can keep your premiums the same, but we're going to reduce your coverage by this much. I have it. So I've had the offer, hey, we'll send you this much cash. You can just be done and walk away. And the problem with that is that a lot of the healthy folks are saying, okay, I'll do that. And then you have adverse selection where the unhealthy people keep their policies and the claims experience is worse and worse and worse.
So why are we bringing this up? Just to, bellyache about it?
Yes.
Sort of. Sometimes it feels good. But others. So the insurance world is trying to figure out how to manage this risk because people have this need. And so can they manage it effectively and efficiently? And one way is through a hybrid life insurance policy that also has a rider on it or some features where it can help cover long-term care insurance. Now, it's not perfect, but it does provide this additional coverage. These are hybrid policies, and that could be another reason why term might not be best. We've got more coming up here on the Wise Money Show with Korhorn Financial Group. We'll pick that back up.
And we're going into
Land of the plane.
Fourth.
I know.
time flies when you're having fun. Well, that concept is you are putting a chunk of money in.
Yeah.
And as long as people
Well, if you're looking at the cash value as being part of it, but these hybrid policies, you get access to the death benefit. So even if you're not putting a bunch of money in, yeah, it's creative. They're coming up with all different ways.
yeah, but
But then you don't have the death benefit as much. But
Right.
if you're trying to manage, like, it sort of solves the ongoing obvious question that everyone that has asked, everyone that's reviewed long-term care insurance has asked. If I don't use it, do I get the money back? And you know the answer. If your house doesn't burn down, do you get that money back too? No, this is just for that risk. But a hybrid policy, well, you get the death benefit if you don't need it. But if you do need it, then then there's no death benefit, or it's greatly reduced. So, but yeah, it's expensive, and you gotta put a chunk in. Yeah.
okay.
All right. So I don't know. We might not hit all of these. We'll see. So last segment. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Make sure you check out the Wise Money YouTube channel. Go to YouTube, search the Wise Money Show, subscribe to it there, and turn on notifications so you're made aware every time we drop new content. Because not only is this talk show there, but all throughout the work week, every business day, we've got a Next Wise Step video that airs right there on this channel, on that channel, taking a financial concept or a financial planning, a comprehensive financial planning perspective and helping you apply it to your financial life so that you can take your next wise step. Make sure you go to the YouTube channel, search the Wise Money Show, subscribe to it, turn on notifications so you're made aware every time we drop new content. All right, let's keep going. Talking about the reasons when, or the times when, hey, term life insurance is good. It might not be best in this unique situation. We left off on if you're trying to manage two different risks. The risk of, well, if I pass away with unfunded goals, I need some there's going to need to be some life insurance proceeds. Or if I live for a long time and have and need care, need long-term care services. There's a lot of different, like there's no standardization yet with these tools. There's a lot of different variations. You want to know those details. So there again, I would say you need to be working with your CFP on this simply so they can be looking at all the bells and whistles and features to ensure that those features are appropriate for your specific financial situation.
That's right. You have an entire industry that's trying to solve a dilemma for society, and that is, as our population is aging, how are we going to care for our seniors? This could be a mom or a dad, a grandpa or grandma, someone who's at a point in life where they need more custodial care. And, here's a reality. I don't know. I'm just seeing this trend happening more. And if you were just to project this out, then you might say, in the future, as a community, are we, or maybe as a family, are we going to need to provide more and more of the care for our elderly in-house, like as a family kind of rallying together? Obviously, there's limitations to this because if they need very specialized, skilled care, you may or may not be able to provide that at home. But if that's the case, does it require, is it likely that in the future people are going to have to retire from their own working career a little bit earlier than they thought, or kind of put some of their own goals on hold? And so we're talking about life insurance as a solution to different problems. And I do wonder, if that mom or dad has an old permanent policy in place, we're often looking at those and saying, well, do you need to keep paying those premiums? Or do you just go ahead and cash this thing in and let's find something better to do with that money? Well, what if that policy was maintained and it was an extra, going back to this idea of an estate enhancement, like creating some extra dollars at the end of your life to bless someone who maybe just blessed you for 2 or 3 years by being your primary caregiver. Maybe they made some sacrifices in their life to put some things on hold. Life insurance could be one way to do that. You could do it also with just writing your estate plan in a way to say, you know what, I want to acknowledge and I want to bless in return this individual who cared for me so wonderfully. You know.
Yep. So work with your CFP. See if that is a risk that you want to manage. The best ways to manage that risk, a non-term life insurance may be one of those. I was getting new tires on the vehicle recently and sitting there waiting and for my appointment.
Did you get tired?
I did. Yes, good one. And I ran into an old friend who earlier in his career came to us with a really bad diagnosis, a terminal diagnosis. And it's great. It's been 10 years. He's defied the odds, beat the odds. At the time, he was given, I think it was 3 years. So it's not like, hey, this is it, but this is it. And all of his life insurance was term through his employer. Mm-hmm. His condition was such that he could no longer work. So what do we do? And we were able to confirm that he had a conversion, a portability, and then conversion. Mm-hmm, mm-hmm. And so where he could not work but keep the life insurance and then shift the life insurance from a term over to a convertible. So this fourth reason is almost an oxymoron, and that is, well, if you have a challenged health history or a complicated health history, or you have some health issues, term insurance might not be the right approach because you have something that maybe could shorten your lifespan, but you have insurance where the clock is ticking.
Yeah.
And so I have had it where I'm looking at an individual with a significant, health issue saying, you're not going to be able to get insurance, but let's try anyway. And he's able to get it. Right? So you never know. Yeah. But in those instances, a permanent policy, it's going to cost more, but is likely best as opposed to term.
Yeah. So what you're describing then is, someone who bought temporary insurance and maybe they had a 30-year window where they're going to make premium payments to the insurance company. If they pass away inside that 30-year window, then the insurance company is going to pay out the life insurance benefit to the family members that are surviving. But what if, you get that diagnosis in year 27 or 28, and you know that, well, there's a better chance today than I ever thought before that I might pass away. What if it's year 31 or 32 or 33? My family wouldn't get any of the life insurance benefits because I live past my 30-year window. And so this is something that if you're listening today, you may want to dust off the old insurance policy and actually start to scrutinize some of the provisions of that contract, because there may be some features or some availability where you, as Mike was describing, you can take a temporary policy and turn it into a permanent one by beginning to pay a larger premium amount. Some policies only let you do that maybe for the first half of the policy or the first 20 years or 25. You might not be able to go all the way up to the end there. But you want to know what your options are, because if something changes in your family circumstances or your health picture, the need, like the conclusion on which tool is best, may change along the way. And you want to know, do you have the ability to change your strategy right along with the changing circumstances?
Yep. And in the spirit of dusting off that old insurance policy, a lot of folks have insurance policies that they bought many years ago, and there were incredible projections, and they were going to have lots of money, and it was going to be fantastic. And then life happened, and they stopped making premium payments, or fill in the blank, or the interest rates that were at 8% when it was first projected and bought, and then the rates went down to the guaranteed, which was 3 or 4%. And so all these years, it's not performed as it was expected. And there are a lot of folks that have a life insurance policy within a year, 2, 3, 4 years of going away, because when the permanent cash value policy the cash value and that goes to zero, the coverage goes away. And this is where if you're dusting off the policy, and again, we're close enough to the beginning of the year where you say, all right, well, one of the things I want to do is do an insurance review. I would tell you, do it with your certified financial planner. And here's why, because it's likely that the agent that you bought that policy from is probably out of the business by now. They if you bought it 20 years ago, it's quite possible that they're not even around and they haven't been servicing that policy. So I would look and say, what do I need to do to keep this policy in force? What would I need? How would I need to change it to keep it in force? Or what additional dollars would I need to be putting into it?
Yeah. Absolutely. That's a good thing to have on your radar as a to-do for this upcoming year. There are times when term insurance is most appropriate, and that's most of the time. And so if you are listening to this and thinking, you know what, I'm hearing all of this, but I actually have this pit of the stomach feeling that I don't have the right coverage. I don't have enough coverage. I don't have any plan or any insurance. And there are people that are depending on my income. And I use also this discussion as an encouragement to work with your CFP and get a plan in place and get the coverage in place and cross that regret or check that box so that you're not living with that. Your CFP should give you clarity and confidence as well as creativity, but don't live with this uncertainty and this regret. So work with your CFP on that. All right, that's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.